It's 11:47 at night. The number on your screen is $847 million. Not your money. Never your money. You just have to make sure it's modeled correctly by 6 a.m. Your Bloomberg terminal hums. Your coffee is cold. You've been awake for 19 hours. Your VP flagged the discount rate as too aggressive. You rebuild the model. You shift it 50 basis points. The valuation moves. You flag it. You send the email. You wait. No one responds until morning. You are 23 years old, 31st floor, glass tower in Midtown Manhattan. You don't attend client calls. You don't sit in negotiations. You sit at a desk and you produce decks, models, comps, memos, one after another. That is your entire job. You are a function, not a person. A function. And somewhere in this building, 12 floors up, someone made $4 million this year. You understand on a cellular level that proximity to that kind of capital is not an accident. It is earned. You are building that knowledge now, one model at a time. At least that's what you tell yourself at midnight when the model breaks again. Here's what nobody tells you before you take this job. The work is not the career. The work is the entrance exam. You're not here to learn finance. You're here to prove you can survive long enough to learn something finance can't teach you. You get promoted. Your title changes. Your hours do not. Base goes to 150,000. Bonus brings you to 250. You start breathing differently. Now you're on client calls. You don't talk. You listen. You take notes. You watch your VP walk a CFO through a high-yield bond issuance terms that are punishing, and everyone in the room knows it, and nobody says a word. You learn something that day, something no model can capture. Deals are not about numbers. They are about a phone call that gets returned on a Sunday because of a dinner that happened 12 years ago on a trading floor you've never been to. The relationships that move capital in this industry were built before you ever walked through the lobby downstairs. You are still outside that circle, but you are watching closely, and you are starting to understand why the deal flow at this bank was never random. You close your first real deal at 31, $340 million debt refinancing. Your name is not in the press release. Your MD's name is. You get a $15,000 spot bonus and a handshake. You tell yourself this is normal. You are almost right. Now, I need to stop here for a second, because I want to be honest with you about something. I've never sat on the 31st floor of a glass tower, but I know what it feels like to grind inside a system that rewards you just enough to keep you from questioning it. I spent years producing work that looked impressive from the outside and felt completely hollow from the inside. Staying late, saying yes, watching other people make the real calls while I built the justifications for decisions that were already made. And the thing nobody warns you about, the thing I wish someone had told me, is this: by the time you realize the game is bigger than you thought, you've already spent your best years just trying to get a seat at the table. That's the real cost. Not the hours, not the sleep, the orientation, what you become while you're becoming successful. I'm not saying don't play the game. I'm saying know what you're trading before you trade it. The next level looks like this. You're a VP now. You run deals. You don't support them. Your name is on the engagement letters. You negotiate the fees. On a $600 million transaction, your bank collects roughly $6 million in fees. You keep none of it. It hits the division profit and loss. But your name is on it, and that means something different now. You fly to Houston, Dubai, Singapore. You sit at expensive dinners where the real conversations happen in the last 10 minutes after the wine, when everyone else has stopped listening. What matters in this industry is almost never said in a full room. This year you make one gray area call, nothing criminal. You know an acquisition is overpriced. You say nothing. The deal closes, the bank collects $12 million. 6 months later, the acquisition underperforms. You don't feel guilty. You feel like you finally understand the rules. That's a more dangerous feeling than guilt, and you don't know it yet. Then the title changes again, and the air in the room changes with it. The managing director title goes on your door. The number in your head is 85 million, what your MD made last year. You don't model anymore. You call CEOs. The CFO of a major utility company picks up on a Sunday morning not because you're charming, but because of what you represent. An infrastructure fund in Abu Dhabi answers on the second ring. That is what access looks like when you've spent a decade earning it. You structure a $3.8 billion leveraged buyout, close it in 90 days, collect 2% before the ink dries, move on to the next one. You have two relationships you protect above everything else. They are not friendships. They are leveraged structures disguised as friendships. Everyone in the room knows it. Nobody says it out loud. You sleep 6 hours a night. You haven't felt nervous about a transaction in 3 years. You're not sure if that's confidence or if something inside you got worn smooth from too much friction. You're not sure you want to know the answer. So you leave, and the game changes completely. You leave the bank. You join a private equity firm. 12 billion in assets under management. Your carry interest if the fund performs lands somewhere between 40 and 90 million dollars. You stop thinking about salary. That category dissolves. You're not advising anymore. You're deploying capital. You sit on 6 boards. Your portfolio companies have 14,000 employees combined. You have never met most of them. You run a 2.1 billion acquisition of a healthcare services platform leveraged at 65%. The structure is clean. Management team absorbs the operational risk. The fund captures the upside. It is legal. It is completely standard in this industry. The company will cut 800 jobs within 18 months. You are not the one who delivers that news. The CEO does. You run the board call. You use phrases like right-sizing and operational efficiency. You have noticed what language does at this level. You filed it away. Your fund raises its next vehicle, 17.5 billion, oversubscribed. Limited partners include sovereign wealth funds, a Canadian pension, and family offices you will never meet in person. Individual transactions feel small now. You've started thinking about the system itself. That shift from deals to architecture is the door to the next level. Most people never walk through it. You walk through it. You're running a macro fund, 6.3 billion. You trade currencies, sovereign debt derivatives. You've been quietly building a volatility position on Japanese government bonds for 8 months. No one outside 3 people knows the full thesis. The Bank of Japan shifts its yield curve control policy. Your read was correct. In a single week, the fund makes $380 million. You feel nothing. You move to the next position. You have political access now, not because you sought it, but because your limited partners fund the people who have it. A former Treasury official sits on your advisory board. His job is to make your macro thesis sound policy aligned. He's good at it. Your college roommate makes $90,000 a year as a civil engineer. You haven't spoken in 4 years. Nothing happened. You just moved in different directions at very different speeds. You don't know how to talk to him anymore. This bothers you less than it should. You've noticed that too. You have not lost anything you can name. That is the most precise way to describe what has happened to you. And then you stop being a fund manager. You become something harder to define. You sit on the board of a 90 billion sovereign wealth fund. You don't run trades. You set allocation mandates. You decide which markets receive capital and which don't. When your fund moves, the secondary effects ripple across asset classes before the press release goes out. You are the press release. Direct line to 3 finance ministers. 1 central bank governor as a peer, not a petitioner. You restructure 14.7 billion in emerging market debt exposure over 18 months. Quietly. In coordination with 2 other funds, no single institution outside the 3 of you sees the full picture. When a sovereign signals debt distress, you are positioned before the rating agencies have filed their paperwork. You are not trading on inside information. You are operating at a level where synthesis looks like foresight. There is a difference. You know exactly where that line is. You have not used a public ATM in 6 years. You travel with security. You do not give interviews. You communicate through structured channels, private dinners in Geneva, Singapore, and the Gulf. Nothing is written down afterward. Your name appears on a Forbes list once. You have it removed through an intermediary. Beyond this point, there is no title. There is no level anyone would recognize. There is only the architecture itself and the people who built it. No title. Your name is on a trust. The trust owns a holding company. The holding company holds positions in 17 financial institutions across 9 jurisdictions. Some positions are disclosed. Most are structured through offshore vehicles. You are technically a private individual. You have not executed a trade yourself in 11 years. You make decisions. 6 people execute them. All 6 have signed NDAs designed to survive serious litigation. They do not discuss your role. Not with anyone. A central bank in Southeast Asia is about to announce a rate adjustment. You knew 3 weeks ago, not because anyone told you, but because you've spent long enough inside the architecture that you can read it before it speaks. The structure telegraphs itself to people who know how to listen. Your carry interests across active funds total approximately 2.4 billion in unrealized value. You have a family. You love them with whatever remains after everything else. You see them on holidays. You stopped trusting your own preferences a long time ago, not because something broke, But because calibration replaced instinct somewhere along the way, and you didn't notice until it was already done, you are not happy. You are not unhappy. Those categories dissolved somewhere around year 15. They were replaced by orientation, a permanent read on the environment, a constant positioning of capital against risk. You don't know what you would do if you stopped, so you don't stop. Somewhere below 40 floors down, maybe more, a 23-year-old walks through the lobby of a glass tower in Midtown Manhattan for the first time. He badges in. He finds his desk. He logs into his Bloomberg terminal. He sits very still for a moment looking at the numbers. He thinks this is about money. He's already wrong. It was never about the money. It was always about the architecture underneath, who gets to build it, who disappears inside it, and who becomes impossible to distinguish from the machine itself. The machine doesn't stop. It just finds new people willing to find out what it costs.